Hey, welcome to What the Buck. I'm Ben Nye. I'm joined today by Sam Frost and Matt Krebsbach down to the end. I got a grin out of Matt because of our pre-production meeting.
Yep.
So in this segment, we're going to be talking a little bit about Russia. We're going to hit some politics, talk a little bit about the taxes plan and what that means for you and what that means for companies. I'm going to talk about stock buybacks and what is a stock buyback. Bitcoin, because everyone's talking about Bitcoin. We thought we just joined the bubble. Part of the bubble, you know. And then we're also talking about another bubble, which is college coach wage inflation, because it just seems like all these football coaches are moving here, there, and everywhere, and they're getting paid a ton of money. So let's just kick it straight off with Russia. Russia is banned from the Olympics by the Olympic Committee, the International Olympic Committee. It coincides with Putin coming out saying that he plans to run for another 6-year presidential term. The Olympics are obviously coming up in February, and Russia is actually pretty good at the Winter Olympics. Not so great at the Summer Olympics, pretty good at the Winter Olympics. This was a topic of conversation prior to the Summer Games in Rio in 2016. And at the end of the day, the International Olympic Committee said that Russia would be able to participate. Now they seem like they want to put sanctions a little more on Russia and say that they can't participate in the 18 games. What are your thoughts on
I just think it's funny that they're banned from the Olympics and yet they host the World Cup next summer. It's kind of it's corrupt FIFA. Call them out.
No, it's incredibly corrupt. Also, the fact that Russia isn't really responding to this in a significant way. Do you think that
I can't imagine it sticking for that long.
Yeah,
I mean, something like the Olympics is just, everyone likes it when everyone's there. Especially with winter, like you said, when you have the best competition with Russia. Like they're great at hockey. I mean, like among other sports, but. What's a hockey competition without Russia in it,
Do you think there's any read-through for a company like, I guess, Comcast owns NBC, who will produce the Olympics, or I guess would be like the main broadcaster of the Olympics? Is there any read-through with that? Or
I almost wonder if that actually helps them, because fewer medals for Russia mean record medals for the U.S. because they're like, other than Sweden and Norway, there just aren't very many countries that are good at the Winter Olympics. So I think the U.S. does well, and I think that really helps.
You're sleeping on Canada, I think.
Yeah, sleeping on Canada. Canada could really come, like some of the alpine skiing, and the ice dancing too. The ice dancing is big for the Canadians.
Well, touching on Putin with that 6-year term thing, I think that's comical too. He's going to be in power as long as he wants to be in power. He doesn't have to run for anything.
It's interesting. I thought that was interesting too, that it's like announced that he's going to run for another 6-year term instead of like, nope. Putin is the president for the next 6 years.
I mean, it would almost be laughable if it wasn't actually reality, but it is. So, yeah, I guess go America in February.
You think Putin wants return favors from Trump in that election?
I mean, I think Putin's probably going to win by a vote of 99% to 1%. And they just
and
give
that
1%
won't be voting next year.
Yeah, they won't be around any longer.
They won't be around to vote.
Moving on with politics, good segue to the tax plan. There's been a ton of market moves in connection with the tax plan. You have tech selling off. You have a lot of consumer discretionary stocks that were basically left for dead, rallying like a house on fire. You got things like Target and TJX doing well. Starbucks has done well. Comcast, actually, what we've talked about, has risen in price, in part because they're going to be helped so much by this tax plan. What are your thoughts on it? Do you think that it has a meaningful benefit if it actually goes through, and what are the chances it actually goes through?
Yeah, so I think it's bifold for someone like Target or whatever. They've paid approximately a 35% tax rate year after year. So you cut the tax rate from 35 to 20% or whatever the proposed rate is. That's a huge, tailwind to their earnings per share. And so then all of a sudden Target's, EPS spikes. They got more money to invest back into the company or to pay out even more dividends. But then you also have, the consumers, us, who are going to have more money in our pockets, who can now go buy more items. So I don't think it's really a shock that the consumer discretionaries did so well on the news of the tax reform. In terms of whether it goes through or not, I think, we actually talked about this not on the podcast, I don't know, about a couple weeks ago, saying, do we think any tax reform will go through? And I think the general consensus was, if there's any tax reform, it'll just be it won't be the main thing. It'll be something that Congress can be like, we're going to vote on this on January 12th to try to say, we're almost there. We just have to vote on it. But with this, I think we all assumed the Senate wouldn't propose something that was anything comparable to what the House has. And then they came out with their proposal, which I think is
very similar.
Very similar. And so when they said they want to get done by Christmas. I don't know that it gets done by Christmas, but I don't know. I think it'll be soon.
What are your thoughts, Matt?
I just talking about the cutting the corporate tax rate. I mean, that's probably the biggest point in the tax bill, among other things. But just talking about the corporate tax rate, I mean, it's obviously gonna benefit all those corporate. It's a corporate tax. So it's going to benefit all the corporate companies, and indirectly, I'm going to take a liberal stance on this. I think it benefits wealthy people outsizely because they're the people that own those companies and hold the stocks in those companies. I think that's just how it is.
Interesting, but it doesn't benefit companies like IBM, which already pays a 7.1% tax rate.
Like the consumer discretionary stocks, they pay like the full tax rate because most of their stuff's done in the U.S. So they're paying low 30s, and you have the tech companies, some other biotech or healthcare names that they pay, in the teens for the most part. Mm-hmm. Like you said, IBM. So, I mean, they've gotten crushed. It's a rotation of money from those low tax companies to companies that are going to get the larger benefit of the tax bill, assuming it goes through like the discretionary stocks and financials, which has done pretty well.
Mm-hmm. Does this continue, or do you think it's pretty much priced in? Like, do you think that this sell-off in tech is going to continue?
JP Morgan, I saw, said they think the tax bill is 50% priced in. Mm-hmm. I didn't look at the rationale behind that, but that's what they said that a couple of days. I think it was like Tuesday or Monday or Tuesday.
I love when people come out with these probabilities and justify these probabilities, but kind of reverse engineer them so they can say, they can sound smart, but actually don't really have a thesis behind it. I don't know. Maybe JP Morgan does in this case, but I feel like a lot of times people want a probability, so these analysts give them a probability, but there isn't really a quantifiable, replicable process for getting that.
If it actually is 50-50, I mean, as soon as something actually is concrete, you're going to see more drastic moves,
And see,
assuming that's true.
The other thing I'll say, though, is that whether it's 50% priced in or not, whether tech still has some pullback left in it or whatever, they will also benefit from the tax cut. And because now, again, we're talking about consumer discretionary companies. Now they're all trying to compete with Amazon. And so now you have a little bit more money in your pocket. You can turn around and invest a little bit more into your technology in terms of, whatever, automating various stuff that they do.
The thing is with that, like that's like the what Republicans are or the House and Senate are pushing for that, but I think studies show for the most part that isn't the case in practice. Like when companies like that actually do get windfalls of money, or you do cut the corporate tax, they just hold on to it, or buy like more stock.
But they're not getting a windfall of money. Like
they essentially are, though.
I mean, sort of, but it's going to be just year by year. It's not like what you're saying, I think, is more relevant for like the overseas tax holiday. Say, if you bring back all this money, like you can just pay a 10% rate on it. And that's when it's like really shown that money tends to go straight back into like share repurchases or dividends or something. It's not reinvestment. But, and again, I was going to address this too. Like you said, you take a liberal stance from that it benefits the wealthy more. I think, and again, this could just be me coming from a conservative stance, but I think the assumption is that if you cut taxes for the people who own the companies, the big shareholders, or if you cut taxes for them, they're the employers who then have more money to pour into talent coming in. And so you should see wages rise, whether that happens or not.
I think in a perfect world, that's what should happen. But in the real world, I don't see it happening that way myself.
Yeah. Interesting. Things are getting a little feisty here. So moving on to share repurchase plans, actually. Home Depot's $15 billion announcement today saying they're going to buy $15 billion of shares back. And
it's easy to do with a lower tax rate.
And T-Mobile says they're going to buy $1.5 billion back. To me, Home Depot's makes a lot of sense because they actually have a lot of cash flow. I think it's debatable whether T-Mobile actually has any free cash flow where they can actually buy back stock. I think this is kind of just T-Mobile almost saying, hey, look at us. We're doing so well that we can actually buy back stock. Please don't actually make sure that we're doing so well that we can buy back stock.
Yeah,
please don't check our math on this.
That's really interesting with T-Mobile because I was kind of the same thought process because we looked at T-Mobile last year and we were having the concerns that they didn't have the cash flow to maintain being competitive with AT&T and Verizon and the amount of money it takes to just build out like the 5G network and stuff. So it's really interesting. Like I know they've done well over the last year, but it's interesting that they think that they have enough cash flow to turn around and repurchase shares like that.
Right. We talked with the lead analyst from Merrill Lynch actually a few months ago, and his view is that Verizon and AT&T have the cash flow to do dividends. They have the cash flow to do share repurchases. They have the cash flow to invest back into the company and come out with a new 5G network. You're seeing Verizon going to start in select cities in late 2018. T-Mobile, he said, though, it's debatable whether or not they even have enough money to actually reinvest into the company, let alone do share buybacks and dividends. And he said Sprint's just kind of they're living on borrowed time almost. Mm-hmm. So that's kind of interesting. What are your thoughts, Krebs?
Like you said, I'm surprised they have the money to do that. You think they'd want to invest into their spectrum, into their infrastructure to actually compete on a better network side of the wireless stuff, but I guess they don't. They think they're fine.
I think this is actually great news for companies like Verizon and AT&T because it means that T-Mobile actually has to manage their business for profit now. Because what you've seen over the last few years is that T-Mobile is essentially giving away their product. Mm-hmm. And they're giving away Netflix, they're giving away all this stuff, they're giving away an extra line. And now they're saying, instead of spending all this money to give stuff away, we're actually going to be buying back stock. So that gives them less room to just cut prices. And I think that's good for companies like Verizon and AT&T because it makes the industry pricing a little more rational.
And in terms of Home Depot, I don't know if we're done on this topic, but in terms of Home Depot, with their capital deployment is highly geared toward buybacks. I mean, in the past, 7 years since interest rates have been so low, they've put on a ton of debt on their capital structure and buying back a ton of stock on top of all their just free cash flow. It's just incredible amounts of stock buybacks.
I'm sorry. So we got to go back to the tax situation. When interest rates were cut so low and you're under a president who is so anti-business, I think we've had, this has been an 8-year recovery, but there's been zero incentive to invest into your company or to invest into projects because you had a president who's doing everything he can to crush you as a company. And so that's why I think that this could, the cutting the taxes or whatever, could be different, and you could actually see companies saying okay, now we have a pro-business DC, now it's time to invest back into our companies and into projects because we're not worried about having a president who's trying to spike taxes on us and do everything he can to pull money from us. And we've taken on debt to fund these new projects, and we can't generate cash flow to pay off our debts. And so, I don't know. I think Home Depot is a perfect example of that. Of they're like every other company. They went 6, 7, 8 years or whatever, just taking on debt and paying, buying shares back.
Yeah. So moving on to Bitcoin, the topic that's on everyone's mind right now, because if you had invested $1, so say $100 in Bitcoin when it was trading at $1, you now have $1.3 million. $100 to $1.3 million. That's a lot of money, and it's all digital. So it's not taxable, right? Or at least not until you sell it. I don't know how that works, but there's
Ben doesn't hold Bitcoin.
I have $0 in Bitcoin. I don't have a dog in this fight. Bitcoin. There's famed investor Mark Yusko, and he says that Bitcoin is going to $400,000 per Bitcoin. For context, it trades currently at just over $13,000. which is a lot of money. But $400,000 is a lot more money. At that price, he claims that Bitcoin would have an equivalent value. If you add up all the Bitcoin in the whole world, it would have an equivalent value to all the gold in the whole world. But the problem he says, but you don't really know how much Bitcoin is lost. So maybe if there's 21 million Bitcoin out there, maybe there's actually only 20 million. Some people say that we've lost 4 million Bitcoin, so there's actually only 17 million Bitcoin in circulation, which would have that per Bitcoin price even higher. So you have upside potential. And then he says even beyond that, if it becomes a currency, I mean, you could be at $1 million of Bitcoin. I mean, $1 million per Bitcoin, 400,000 just to start. I mean, should we be getting in on this?
I think I don't know. Bitcoin can be wiped out in any moment by the Federal Reserve comes out and says, our job is to manage the money supply. We're supposed to manage to keep the economy from overheating so we can manage, interest rates and, spur economic growth or keep us from overheating, manage the unemployment rate and wages and all that. If all of a sudden there's tons of money, it's an actual currency that people are using Bitcoin, now all of a sudden they can't manage the economy. And so the Fed can come out and just say, it almost makes them irrelevant, right? And so you could see like the Fed, you see the ECB, any of these big central banks just come out and say, hey, no more. But then you also have the threat from governments. And so when you have a huge money laundering scheme, some huge, drug deal or whatever that's all funded through Bitcoin or whatever on the black market or whatnot, that's when you're going to see like Washington or any big government come out and say, that's it, Bitcoin's illegal. You can't use Bitcoin for any transactions and you're done. And then Bitcoin, if it makes it up to $400,000 a Bitcoin, comes right back down to $20 a Bitcoin. So not to say that it's a bubble now, that it won't continue to rise. The scary thing is just that, like, didn't it fall by 20% like last week at one point? And so
then it went back up like 50
right.
An hour later.
But I mean, that's my point though, is like if this thing can fall by 20% on any given day or whatever, like a central bank, they can just wipe it out. I don't know how much higher it's got to run, but it's just,
I think we've established that as far as currencies are concerned, you need two categories. It needs to be a store of value and a medium of exchange. Is it a store of value? I mean, if it goes down 20%, I mean, that's not really storing value. Mm-hmm. Is it a medium of exchange? I think most of the Bitcoin that's being purchased is for investment purposes or speculation purposes rather than actually buying and selling stuff. But I wanted to ask Krebs actually a little bit, because of all of the people, of Sam, myself, and him, Krebs is the only one who actually manages a portfolio of Bitcoin. So in addition to little backstory, in addition to managing traditional investments, he actually also managed alternative investments, things like Bitcoin. He's going after his CAIA designation, which is Certificate of Chartered Alternative Asset Investment Management.
Almost.
So tell us a little bit about what your thoughts are.
My whole with Bitcoin is to me, it doesn't seem like there's much unique about Bitcoin. Not about like blockchain or any of that stuff, just strictly Bitcoin. It's just, the only reason it's big is because it's the first mover, I think. I mean, like Sam was saying, there's something can come up and it just changes instantly. Like they had a fork in the code in the blockchain, and now there's Bitcoin Cash as well as Bitcoin. And Bitcoin Cash is trading at like $1,000 a piece now. So it's just like poof, out of thin air, you have another, basically a Bitcoin, same type of thing, same cryptocurrency, just out of nowhere. It's like you said, something happens and then it's just gone. Yeah. I don't see much unique about it. You see all these initial coin offerings, how many millions of dollars are being poured into them from private equity and hedge funds.
Well, it's the whole venture capital scenario.
To me, it feels too speculative. Like
people say, if I just diversify over these 30 or 40 different cryptocurrencies, if just one goes big, I'm going to make a ton of money. But there's a logical fallacy in that, because you end up not doing your due diligence on those 30 different coins or crypto coins, which are really just ones and zeros on a page. So do your homework on that. And at least for me, I'm cautious. Another place where we're seeing inflation in addition to cryptocurrencies is college coach wages. Taggart, the Oregon coach, just got hired at Florida State, and he was going to walk away when they offered him over $4 million to coach their football team. He was insulted by that offer. I mean, yes, I would be insulted if someone offered me only $4 million as well. But what are your thoughts on this coaching carousel?
Of the money side of it?
Of the money side of it, yeah.
I don't think it's that surprising when you consider that the athletes aren't getting paid, and you still have the inflation on ticket prices, on apparel sales, like that. All the money's going somewhere, and those ticket sales and apparel sales go up if the team's good. So you're gonna try and get literally the best coach at whatever cost to get that team good. I think it makes sense to me, I guess.
It's interesting to me because most athletic departments aren't profitable, and the ones that are, for the most part, are buoyed by football programs, and some basketball programs for the most part. And so, but the thing that I think people talk about that often, about is it even worth having an athletic department or an athletic program if it's just pulling money from the school. But I agree with Krebs. When you go to school, like, it's fun to go to a school that you're going to have fun going to football games, or you're going to basketball games if you're like going to a Duke or something like that. And so I think it does bring students in, and then you got apparel sales, ticket inflation, the actual like sport itself might not be profitable, but I think it does a lot for the school as a whole.
But is it worth, especially at these state schools, is it worth making your college football coach the highest paid employee in the state? I mean, that's just crazy. The highest state employed person is invariably the college football coach of the state school.
What do you think?
I mean, you're talking about Tennessee, correct?
Tennessee, I'm talking about Washington.
Just speaking of Tennessee, I think it kind of does make sense when that's like in the top 5 brings the most revenue of any football program in the country. I mean, I can buy into it.
Yeah.
Do I agree with it? Not really, but I can buy into it.
I'm with you. To answer your question, Sam, I buy into it. I've been arguing devil's advocate, but I mean, at the end of the day, I think people should go if they're willing to move and they think that they can make more money, more power to them. I mean, it's not. Who am I to say that they can't do that?
If you were the AD at Washington, how much money would you pay for Nick Saban?
I'd pay nothing. I think we have the best college football coach in the country.
All right, there you have it.
Okay, geez, man. All right, stay tuned for the rest of the show. That's it for us. Thanks.
Hey everybody, welcome to a brand new segment. This one is called Hi Mom. Ben, I got asked a question about a investing podcast today from my own mother. She said, hey, if you do one of those podcast things again, you should talk about the Aetna and CVS merger. So that's what we're going to do, but this is maybe a recurring segment, maybe not. It's about 3:30 on a Tuesday right now, and my mom would just love this, so we're just going to go ahead and crack a beer for her. So Mom, this bud's for you. Let's go ahead and jump in. So Ben, let's talk about CVS and Aetna. CVS, I guess, technically buying or merging with Aetna, just depending on how you look at it. Massive, massive deal. I think a $69 billion bolt-on here. Pretty ridiculous. So let's back up a little bit. Let's talk about CVS, their role kind of in the healthcare space. I know a lot of people obviously will know what CVS is, but really their role is, kind of a PBM and what that means, and also take a step back and look at Aetna. So you want to jump in on some of that?
Yeah, so what CVS does is I think that a lot of people, when they think of CVS, they think of the corner convenience store, which is true to an extent, but the cash cow, what they really make their money is negotiating drug prices and then selling them to the consumer at a markup. So they've been doing this for a while, since their acquisition of Caremark, which was actually a merger of equals back in the mid-2000s. And that acquisition really changed the dynamics of what CVS is going to look like in 2006. And so now what you have is CVS goes to these drug companies and negotiates pricing, and then acts as kind of the middleman between them and the insurers, between the drug companies and the insurers. So what you have now is CVS says, okay, well, we're sick of kind of being the middleman and the convenience store player. We're worried about other people kind of trying to take this middleman job. So we're Amazon has been rumored to
Yeah.
be wanting to get into this middleman business of negotiating prices between drug companies and insurers. So what CVS said is, okay, we're going to try to expand and really control the insurer, control the middleman operations, which they currently do, and then control the end consumer,
Yep.
which they currently do. So now they'll be a vertically integrated. They'll be able to take the insurer's money and get you the drugs all through just that single company, which would be a lot more than they're doing right now.
And it's kind of an interesting thing when you look at it. You know, it's not hard to see CVS's angle in terms of why they want to accomplish this. It fends off Amazon, which is huge pressure. We've talked about that theme a lot on this podcast, both the Young Bucks show as well as the investing podcast. We've talked a lot about that and just, how Amazon can say they're going to, dip their toe into the water on something, and all of a sudden an entire industry will get into trouble. When the Whole Foods news came out, basically anybody that had any grocery exposure, even Target, where they're really not even making money off groceries, all of a sudden they're under pressure because Amazon's getting into the grocery space. So you understand pretty immediately the reason that they're going to want to kind of give Amazon this stiff arm and kind of align themselves with someone else. So that makes sense. It also makes sense that, hey, if we can integrate more fully and basically guarantee that we can continue to renew these contracts on the PBM side, that we can continue to get insurers to come right back to us, that makes sense. And then you have this built-in network of distribution centers that are the existing CVS stores. Maybe what you think about. When I think of CVS, I think of, running in to grab a six-pack of beer because I don't want to drive all the way to a liquor store or something like that, or maybe I'm just craving Twizzlers, I hop in there, but that's not really where they're making their money. But so they've got an interesting plan to use those facilities. They're going to take these facilities and basically kind of make them these little like healthcare hubs. You can kind of see where that might go. You expand upon the idea of kind of these quick serve minute clinic type models where you can get some healthcare. You maybe add a healthcare consultant type operation going on there, people that are working there. And then what they're really selling to investors and consumers, especially on the consumer side, is the benefit of aligning themselves with a massive insurer like Aetna and saying, hey, this is going to be a really nice opportunity for us to save you money, if you're actually spending money on these drugs and using CVS, Aetna, this massive company. You're gonna win if you're the consumer, which is kind of, I guess, a debatable point in and of itself.
Yeah, they say that they will have more buying power with the drug manufacturers, that they'll be able to buy drugs for less, which kind of puts into question the entire business model that they've been running for the last 15 years, because this is what their whole proposition was, that it's good that their role was good for the industry because they actually got prices less than other people would, because they had these relationships with the insurers and had that buying power with the drug distributors. So now they're saying, well, we're going to have even more buying power and we're going to get the consumers even less price, less of a cost for the drugs. So it's a good selling tactic. Whether or not it actually comes to fruition is something to be debated. But then you can also debate, well, are they actually adding more value simply in terms of the integration? And I think, Andrew, when you think about this acquisition, you're a little more negative than me on it because you just don't think this cost is going to come down.
Yeah, I'm very skeptical of it. The rate of healthcare inflation is staggering. When we talk about inflation, typically we think of 2-3%. What's going to happen to the economy? What's GDP growth look like? What's CPI? Kind of these big factors that we tend to look at when we think about inflation. But healthcare inflation is significantly higher than what core inflation is. There's a number of buckets that are kind of unique if you ever want to see inflation rates. For instance, kind of the luxury items tend to have inflation rates significantly higher than core CPI growth or something like that might be. But healthcare is just unbelievable. Healthcare and the cost of education, those tend to be two that just really skyrocket. And it can be really frustrating because healthcare, we tend to kind of have this ongoing debate as to whether healthcare provision should be an inalienable right, so to speak, and that, hey, we have to have it. And then you also see these skyrocketing costs, and it becomes a real challenge. And I'm just incredibly, incredibly skeptical of anyone in healthcare, period, saying, hey, we found a way to save consumers money. I just don't think that happens very often. And we've seen United Health actually has Optum, which is a division of them, which is kind of this data-driven, smarter healthcare solution type program in which they're relying on a lot of their own massive pool of data from the people that they're insuring and the cost of medical care, all that kind of stuff. And then they also have OptumRx, which is kind of on the pharmacy benefit side, the prescription management side. And so in theory, like Optum Health and OptumRx ought to be working together and saving the end consumer money. But that's not happening. Through OptumRx, drug prices are continuing to rise. They're still going up. So, from a business standpoint, it's really important to separate these things and identify what's ethical or unethical. I don't know that this is an unethical measure, so to speak. At the end of the day, as investors, we're big believers in any management team that can maximize shareholder value. We understand that. And if they're not breaking laws and they can get approval from the powers that be, including the shareholders, it's not really our job to stand in the way and say this shouldn't happen. But I'm incredibly pessimistic with regards to whether this would actually save me money as an end consumer with the CVS and Aetna merger.
Well, the reason they're pushing this is because they want to get it approved.
Exactly.
Because if they don't get it approved, then they need to go to the government and say, this is going to actually be good for consumers because of X. The thing is, I think they made a massive mistake in trying to argue that they're going to have lower costs, because now they're holding themselves accountable for it, and it's a lot more difficult to actually follow through on that promise, because I'm with you. I don't think that costs are coming down. And I think that they'll probably say, well, their costs aren't going to go up as much, but consumers don't really care about that, and that's a arbitrary benchmark.
Right.
I think they should have sold it as something more that there's a value to be had for having a vertically integrated platform. So if you have insurance for Aetna, you can go to any CVS, for instance, get your drugs, no hassle, no turning in the insurance card. Maybe you just show them your ID. Maybe you even get checked up there at the Minute clinics, and have everything as a much more intuitive and quick way. And healthcare is no more of a hassle, especially the healthcare maintenance,
Right.
as people talk about. And I think that's how they should sell it. That it's going to cost more, but you're going to get more value. You're going to get much more value. This is the same reason you buy an Apple product. You get the integration of the hardware. You get the integration of the software. It works with your other devices. The same way you buy really any premium good, because you perceive there's an additional value there. And that's what I think that Aetna and CVS should be selling to the government, not that it's going to reduce costs, because I think that's not going to happen.
Yeah, I just don't think there's any way that's going to happen. And I'm sure they'll figure out some kind of floating benchmark. I mean, in some regards, part of the problem with healthcare is that it is managed, at least to some extent, kind of like the government. And there's these wild inefficiencies, and whenever any kind of tax plan is rolled out, it's usually, hey, we're going to save, the middle class X amount. And then it comes out, well, hey, they're not really going to save them X amount. It's only going to be Y. And then they quickly counter with, well, it's Y, but if we didn't do this, it would be Z.
And we would do it over 10 years.
Yeah, exactly. And there's all this fine print. And you get to it, nobody's telling you a bold-faced lie, but the implications in terms of what the headline is completely false. And so, I'm sure they're going to have some kind of economic defense even 5 years down the road when they say, oh, well, yeah, it's now twice as expensive to get this drug, but it would have been 2.5 times as expensive to get this drug if it wasn't for us. So it's one of those things, and I think it's tough. I mean, to your point, Ben, in terms of kind of offering this shinier, cleaner, easier, more efficient model, I think that's tough to get approval on from the DOJ and everybody involved. And it's kind of one of those tough things. I mean, I think if you're a savvy investor in some regards, you're in favor of this because you realize they're not doing this to really save people money. They're doing this because it creates a business opportunity. If you're a large activist shareholder at CVS, for instance, which we've been in and out of CVS to varying degrees across our portfolio, we're certainly not huge holders of it by any means. But if you were, I think you would be in favor of this because it's going to fend off Amazon. It's going to make all that sense in the world. But again, it's just not the sexiest thing to say, hey, we're gonna fight this off and we're going to increase prices and we're going to make more money. That's not going to fly with the DOJ.
Well, and the other X factor you have is it's a massive election year next year. You're going to have the midterm elections, and the Democrats are really going to be wanting to get back on top. And the way they can do that is find a straw man. And the lobbying dollars are going to be flying like crazy from CVS and Aetna toward the various parties here.
Right.
The CEO of Aetna is going to get paid, if this deal goes through, $500 million. Woo! Not a bad paycheck there. So the lobbying dollars are going to be flying. it's going to be an election year. I think this could get really messy, and this is going to drag on long time. They don't even expect to close this until the second half of 2018. So, I think the earliest the consumer actually sees any impact is probably into 2020, really, because 2019 they'll have to integrate some stuff, and then it's just going to be a long process. But in the meantime, for CVS, they get the headline risk away because Amazon, if to the extent that Amazon actually comes in, they can say, well, we're actually working on this deal.
Yeah.
And so we're actually doing something about it, which people will like.
So definitely something to keep an eye on. Ben, you taking any particular action with, either of these companies right now, or are you just going to kind of hold off? And I guess my opinion is almost that it's probably a good little way to save face if you're CVS for the short term. Do I really view it as a huge opportunity for either company? Not necessarily.
Yeah, no, I'm with you on that. I think there's so many uncertainties with this, and the synergies that are expected are just entirely arbitrary, in my opinion. I would be interested in trimming CVS on a balance. I think it's come back a little bit, so I wouldn't really be selling here. But if it got up into the 80s again, I'd think about selling.
There you go. So keep an eye on it. Stay healthy out there, and that way you don't have to really spend any money on healthcare. So that's my advice. It's my professional recommendation. Don't get sick. Get your flu shots.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.